Good afternoon. I'm John McArthur, Chief Investment Officer at Krilogy. With minimal financial market volatility in 2021, it's evident the pendulum has swung in the opposite direction here in early 2022. I'd like to zoom out and paint the picture as to why things aren't as bad as perhaps perceived, and to help explain some possible causes of this market turbulence. This first chart is a view of market implied rate hikes from JP Morgan and Bloomberg data. In looking at this chart, you can appreciate the magnitude in the shift around rate hike expectations from just a few months ago. As recent as September, there weren't expectations for even one hike in 2022, and now the market is pricing in 7, as Bank of America, Goldman Sachs, and now JP Morgan are all singing harmoniously with this call. This sure is a lot for the market to digest in what is a complete change in policy expectations. Is it any wonder we've opened the year with over a 10% correction in the S&P 500 and an even greater decline in the NASDAQ and Russell 2000 small cap index exceeding 15% in each? I believe if the Fed were truly worried about inflation not settling down, at least in part, then an abrupt ending to emergency-era monetary policy would have already ceased. Yet balance sheet expansion continues into March. Ironically, Minneapolis Fed President Kashkari indicated just a few days ago that we should be well on our way back to 2% inflation by year end. Now, I'm not sure I buy into this view either. Quite a disconnect from the 7.5% year-over-year CPI print from a week ago. I'm suggesting, perhaps like many things, the truth or reality is probably somewhere in the middle, as 7 rate hikes and 2% range inflation by the year end don't quite square up. To be clear, the Fed has navigated through an extremely difficult environment and has been charged with a tough task in a very abnormal period. So let's look at one such distortion. In the purple line on the chart below from Natixis, you'll notice just how far above historical trend that goods consumption has been over the last 2 pandemic years and how it's begun to roll over. The normalization between goods and services consumption should help partially dampen the inflationary pressures related to an extraordinary consumption of goods and the pressures that have been put on many systems tied to inflation as a result. In addressing the pessimistic mood that's set in here regarding inflation in early 2022, it's important to not lose sight of reasons for optimism amidst a lot of noise. Earnings growth for the quarters beyond a dampened Q1 have been adjusting upward in a meaningful way over the last few months at a more normalized long-term trend rate. Both corporations and consumers are generally both financially healthy, and we just experienced a very strong retail sales number. The market has had a healthy reset, especially in the frothier market segments, such as non-profitable technology as an example. In fact, over 50% of the S&P 500 companies have sold off 20% or more from their highs. This number is approaching an astounding 80% of companies in the NASDAQ that have sold off 20% or more. We're also starting to see some green shoots leading to the easing of inflationary pressures in some areas, including supply chain pressures during a normalizing shift from goods to services consumption. Additionally, inventories are getting replenished and companies are looking to spend, as can be seen on this chart from JP Morgan, which bodes well for the economy going forward. And last but not least, we've finally reached the eventuality of the first rate hike that we've seen in years. And history shows that taking the long view wins out the majority of the time. As shown in this chart from LPL Research and Bloomberg, in most instances historically, stocks are 6 to 12 months higher after the first hike. And for those worried about a series of rate hikes this year as we work through 2022, history shows that's also not reason to fret, as we've seen this many times before. This chart also from LPL Research shows prior rate hike cycles and stock market performance in the year in which there were a number of hikes. You'll notice that both the average and median market performance in years with a number of hikes has been positive. So what should we be concluding at this point? I'll leave you with 3 things. The market has had to digest a lot with such a dramatic policy shift due to stronger than anticipated inflation. So a corrective move in the market is both overdue and healthy. Number 2, History shows that there is a market anxiety around meaningful policy change periods, such as first rate hikes. But taking a multi-year view tends to pay off. And number 3, inflation is a lagging indicator, and we're beginning to see some signs of inflationary pressures beginning to ease in portions of the economy. The question now becomes, how quickly does it fall and to what level? As Liz Ann Saunders of Charles Schwab often says, it's not good or bad that tends to matter, but better or worse. And we're expecting the inflationary picture to get better as we work through 2022. Thank you for viewing our broadcast. I'm John McArthur at Krilogy.